Hey, what's going on, y'all? Steve Peterson with Infinity Investments, your commercial real estate brokerage and investment firm here in Oakland, California. And I want to talk to y'all about a topic that I think is really, really important, especially right now in May 2020. It's creative finance. Because in this pandemic that we're in, and in the commercial and investment real estate world, I think that we're going to see a lot more creative financing deals get done. The reason I think that is because in this last market run-up that we've seen, there's been a lot of all-cash acquisitions. There's been a lot of money put down in the down payment. So I don't think while we're going through this stress of the market, that a lot of sellers are going to walk away from their properties. I don't think we're going to see that. In 2008, people were walking from their commercial investment properties, all right? I don't think we're going to see that. I think what we're going to see is sellers fighting, scrapping, clawing to make a deal happen. And I also don't think the market's going to drop off a cliff like it did before. I think that we'll see an adjustment. I think we'll see a gradual decline, particularly, in the areas I like to focus in is multifamily properties, but also in the other food groups, office, retail, hospitality. There are going to be different nuances, okay? Most of what I like to talk about is multifamily. So I don't think we're going to see a big 70% price drop. I think what we're going to see is an adjustment in pricing, but what I believe we're going to see is a lot more creative financing. So I want to talk to you about the top 5 creative financing strategies. So, and if you like this video, please smash that like button and hit the subscribe so that you can stay tapped into our content, because we're going to be delivering weekly content on real estate and business principles for success. So in terms of the top 5 strategies of creative financing, number one is seller carried first and second deeds of trust. Now in California, we call them deeds of trust. In other states, they're called mortgage. Deed of trust and mortgage, same thing. It's security against the property. First, meaning that it would be in first position. Any mortgages or anything else would be behind it. Second, deed of trust would mean it's in secondary position. That deed of trust is behind the first mortgage. So the reason why I think this is the number 1 strategy, because it's the simplest way to get a deal done. It requires the seller to have equity in the property and willingness to defer them getting that lump sum payment in return for getting a stream of income over a period of time and then getting their money paid back. Let me give you an example. Say a property is $1 million and the seller is having a difficult time selling it. Banks are tight, buyers are scarce, if you will. So the seller offer says, hey, I own the property free and clear. I, as a seller, I will carry an 80% first position mortgage. What you need to do, so $800,000. What you need to do, buyer, put down 20%, $200,000, and then I become the bank. I structure that loan, whatever interest rate, at whatever term. Term means the time when you're going to pay back that loan. And then you, as the seller, become the bank in first position. All right? That example requires somebody to have own the property free and clear. Let's say they don't own the property free and clear, $1 million. Maybe they have a loan of themselves for $600,000 or $700,000. And they say, well, look, you, Mr. and Mrs. Buyer, you need to go out and get your own loan. However, I will carry a $200,000 second mortgage. Therefore, you go out there and get a mortgage for $600,000. They carry $200,000, and then you put $200,000 down. And obviously, the numbers can be massaged. With the second mortgage, there are some things to consider. The bank who's making the first mortgage has to agree to it. Some banks are okay with that. Some banks are not okay with that. So you have to run that by the bank, the lending institution that you're working with. But if they're okay with that, then the next thing you got to worry about is how much money does that bank want you to put in the deal. They want you to have what's called skin in the game. Every lending institution is different. But the bottom line, the great part about that strategy is you can get into the deal with less money down. I've done this several times as a broker. And for you investors out there, a lot of investors think they can't work with real estate brokers because brokers don't understand creative finance, which most brokers don't. However, that's something I cut my teeth on, and I think we'll see a lot of. So that's the first strategy. Seller carried first and second deeds of trust. Now, second strategy is master lease option, which in the residential world is just a regular lease option. Commercial, once you got 2 or more units, we got to do what's called a master lease. Okay, it's where the buyer comes and leases all of the units. Let's say you got a 5-unit building, and the buyer approaches the seller and says, hey, I will lease all 5 units for you at a price, right? A master lease. And what happens is, when you execute this master lease with an option, the deed doesn't transfer. You don't buy the property outright. What you do get is what's called equitable title, rights to the title, a form of ownership, okay? And you have control over that deal. The seller can't go sell it to somebody else during that period of time. An option, by the way, always has to have a period of time in which that option is valid. 2 years, 3 years, 6 months, whatever you negotiate. So you put a master lease in place over all the units, and then there is an option to where you can buy that property at a negotiated price. Okay, up front, in order to bind this, you need to put some money up front, but it can be as low as $1. And I've actually done a lease option, master lease option deal with $1 down. It can be done, and the motivation for the seller to do something like this is, say they're trying to sell the property, just not selling for the price they want, but they really don't want to take out the trash, deal with the tenants and the issues. But they can't sell the property. They can master lease it to you. Now you take over all the responsibilities of the property at a price. You paying them every month. And then your goal in doing that is you acquire the property with the minimal amount of money down. And then there should be an amount of money over and above what you're paying the seller coming to you. Now also, in a lease option or master lease option, when you want to negotiate a percentage of the lease payment, so if you're paying that seller, say $3,000 a month, you want to negotiate anywhere from 10 to 20 to 30% or more, if you can, of that payment to be credited towards the purchase price when you buy the property. So you're making the payments to them and you're getting a credit. So when you go to buy the property, you get whatever that percentage is credited towards your account of the purchase price. That's a form of equity buildup. Like when you pay a mortgage, you pay principal and interest. That percentage of the payment being credited is like a principal buildup, okay? Great way to acquire a property. You don't get the deed until the option is executed. When you either buy the property outright, now you go out there, get a loan, or you sell it to somebody else. And a lot of people who use this strategy control the property and then end up selling it to someone else, never own it outright, but they control it, they make cash flow, and then they make profit on the back end. Great strategy. All right, so number 3 is installment sales, or in California, we call them contract for deeds. Every state's a little bit different, but we call them contract for deeds. Essentially, a contract for deed is an installment sale, and it's just what it sounds like. It's a sale that's broken up in installments. So very similar to the lease with option to buy, in a sense that the deed does not transfer. You get equitable title, rights to the title, okay? But you don't get the deed until you make the final payment of the installment sale. It's a great way to get into property without a huge down payment. There does need to be an initial payment to bind the contract, but that's very negotiable, and it's what you come up with. And then there's monthly payments that you make. Also, there can be quarterly lump sum payments, annual lump sum payments. It's really flexible, whatever you can negotiate. And that's why I think this is a great tool, especially in this economy that we're moving into, because it allows the buyers and seller to use their creativity to solve their problems, okay, without fully putting 30 to 40% down like you would have to typically do in commercial and investment properties. However, like the master lease option to buy, you don't get that deed, right? So that you're not able to take it and then go and get a refi and do all that stuff. However, you do control the property, you control the operations of the property, you can actually sell a property, okay? But you can't go put financing on it until you acquire it. And a lot of people who use this strategy will line up financing to make the acquisition while they have the property under control. This is a great tactic for a property, let's say, that's half vacant or is a property that's going to have a challenge getting financed. You can take control of the property, improve the operations, get it to the point where now the occupancy's up. Now bring new financing in so that you can close it and buy it. or just go ahead and sell it to somebody else. Another excellent way to acquire property. One thing to keep in mind with contract for deed, installment sales, and master lease option to buy. In a state like Texas, I believe in Texas, you're not able to do lease with option to buy. I don't know about installment sales. I can tell you in the great state of California, you can do both, okay? So wherever you are, state-wise, country-wise, make sure to check with your local laws and jurisdictions. But this is a great way to acquire property without going all in up front. The next strategy, and this one is sexy, is the wrap-around mortgage, okay? The wrap-around mortgage, or another word for it is the all-inclusive deed of trust, okay? This strategy does involve the deed transferring, very similar to the first strategy of seller carried first and second deeds of trust, because at close of escrow, when you are the buyer, you will get the deed. Now here's what a wraparound mortgage is. This is a little bit complicated. This is when the seller has an existing loan. Let's say it's $1 million property, and let's say that loan is $700,000. They're selling it to you for $1 million, but maybe you don't have or don't want to put 30% down, $300,000. Maybe you just say, hey, I've got $100,000 I want to put down, and Mr. and Mrs. Seller, I want you to carry what's called a wraparound mortgage. And what that is this. The seller's existing mortgage here is $700,000, all right? What you do is structure a wraparound mortgage for $900,000 that wraps around that $700,000 mortgage with the bank, okay? That $900,000 mortgage is in favor of the seller. So you make payments to the seller. The seller then takes your payments and makes payments to the bank, the lending institution. When we execute this type of a transaction, the deed transfers at close, okay? You get the deed. Here's the risk in this though. The bank, they don't necessarily know about all that, all right? They don't know about what's going on. And a lot of banks have what's called due on sales clauses, meaning when the property gets sold, they need you to run them their money, okay? So let me break this down. This is it is legal to do this. However, in your bank covenants, a lot of times, with the due on sale clause, they want their money, okay? So the bank is not approving this transaction. This is buyer to seller. This is why I think these type of strategies are going to be, important in this new economy, because buyer and seller, you have the ability to be creative. And brokers out there listening to this, you can facilitate these deals and still get paid. Yes, I've done it several times. But you need to be creative and you need to be solutions driven. Also, be careful, because here's the thing you want to do. You want to set up, in this kind of a deal, you want to set up a neutral third party escrow account to collect the payments from the buyer and make the payments to the seller's mortgage company and report it to both sides. Because you don't want the buyer making a payment to the seller, right, on their mortgage, because as a buyer, you're making that $900,000 payment that wraps around the $700,000 payment. So as a buyer, you pay the seller. What you don't want is the seller to take that money and just put all of it in his pocket and say, oh, I forgot to pay my mortgage, right? Because then you'll get a notice and then things get funky. You want to get a third party in place to accept the payments from the buyer and then make the payments to the mortgage company and then report it to both parties, all right? That's a very, very important process. I learned that going through the old market in 2008. I did a couple of these deals. I structured it this way, okay? And that helped both parties be able to operate and navigate through the storm of that time, all right? But make sure you put that in motion. And last but certainly not least, okay, in terms of a creative financing strategy, is the very popular word syndication, okay? OPM, other people's money. Let's say you've tried these 4 strategies and they just don't work. The seller wants their money at close of escrow. You love the property, you did your analysis, it makes sense. This is the one, but seller ain't playing ball with you. So what you gonna do now? Or maybe this is your strategy in the beginning. It's to syndicate the property. And the syndication is typically, all it really is going out and putting capital money together from at least 2 or 3 more people to invest with you to acquire this deal, okay? It's when the seller needs all of their money, you don't have it, or maybe you don't necessarily want to invest all your money, you go out and approach family, friends, and associates and get them to put up capital with you that you can then go to acquire the property. The most, I won't say realistic, but the most common, if you will, strategy of how you do this is you form an LLC or whatever entity, and then you get a loan, you go out there and get a mortgage for typically 65 to 70% LTV, but that down payment is the part where you'll need to get investors from, right? So what's typical is you form your LLC, and everybody who invests, they become a member of the LLC, and they're gonna get membership interest into that LLC. Some person may be 10%, some person may be 20%, some person might be 30%. But everybody is gonna get a pro rata share depending on what they invest and become part owner of the deal. Now, word to the wise, you need to get a lawyer involved if you're gonna do a syndicate, all right? You need to get a lawyer involved to draft your LLC operating agreement and your subscription agreement. And you need to make sure that you're following the securities laws. If you're just doing this with 2 or 3 buddies or people, associates of yours, you still need to get a lawyer involved. You don't have to do some of the exotic private placement memorandums that you would if you're raising 10 or 20, millions of dollars with 10 or 20 investors, but you still need to get an attorney to draft up the paperwork, to make sure it's done right, to cover you, but more importantly, to make sure that the deal is structured properly. So that's the top 5 ways of creatively financing your deal. If this was of any value, again, subscribe to the station, click that like button, let's stay tapped in. I'm also gonna put some resources down in the description below of videos from other investors that have talked about, particularly there's a guy by the name of Peter Harris, who is an expert in commercial real estate, and he has some videos on master lease optioning and creative financing. So tap in with us, tap in with him, get as much knowledge and education you can on this subject. Let's do business and make 2020 our best year yet. Peace out, y'all.